Real estate investing. Thinking about purchasing an investment property, real estate has created large numbers of the world's richest individuals, so there are a lot of motivations to believe that it is a sound venture. Specialists concur, nonetheless, that similarly to any speculation, it's smarter to be knowledgeable prior to making a plunge with a huge number of dollars. In this video, we will share the tips you need to know about real estate investing. So let's dive in. 1. Choose if you're cut out to be a landlord. Being a landowner can be an effective method for procuring land pay, yet all at once it's difficult and fabulous. As well as picking the right property, preparing the unit, and finding dependable inhabitants, there are generally upkeep bothers and cerebral pains. How much do you prefer being around a tool stash? How are you at fixing drywall or unclogging a latrine? Of course, you could call someone to do it for you, or you could enlist a property chief. However, this will eat into your benefits. Landowners who have a couple of homes frequently fix up and set aside cash. Obviously, that changes as you add more properties to your portfolio. Lawrence Pereira, leader of King Harbor Wealth Management in Redondo Beach, California, lives on the West Coast but possesses properties on the East Coast. As someone who says he's not the least bit convenient, he makes it work. How? I set up a strong group of cleaners, jacks of all trades, and project workers, says Pereira. 2. Pay down personal debt. Clever financial backers could convey obligation as a component of their portfolio speculation methodology. However, the normal individual ought to stay away from it. In the event that you have understudy loans, neglected doctor's visit expenses, or kids who will go into school soon, buying an investment property may not be the right move for the present. It's not important to settle obligation, assuming your return from your land is more prominent than the expense of your obligation. That is the computation you want to make. Pereira recommends having a money pad. Try not to set yourself in a position where you come up short on money to make installments on your obligation. Continuously have an edge of well-being. 3. Secure a 20% or larger down payment. Venture properties, for the most part, require a bigger initial investment than proprietor-involved properties do. They have more rigid endorsement prerequisites. The 3% you might have placed down on the home where you, as of now, live won't work for venture property. You will require essentially a 20% initial installment, considering that contract protection isn't accessible on investment properties. You may nonetheless have the option to get the upfront installments through bank support, like an individual credit. 4. Track down the right location. The last thing you need is to be left with an investment property in a space that is declining as opposed to stable or getting steam. A city or region where the populace is developing and a renewal plan is in progress addresses a potential venture as a valuable open door. While picking a productive investment property, search for an area with low local charges, a nice school region, and a lot of conveniences. For example, cafes, bistros, shopping, trails, and stops. Furthermore, a neighborhood with a low crime percentage, simple admittance to public transportation, and a developing position market might mean a bigger pool of expected leaseholders. 5. Would it be advisable for you to buy or finance? Is it better to purchase with cash or to fund your speculation property? That relies upon your effective financial planning objectives. Paying money can assist with creating positive month-to-month income. Take an investment property that costs $100,000 to purchase. With rental pay, expenses, deterioration, and personal duty, the money purchaser could see $9,500 in yearly profit, or 9.5% yearly profit from the $100,000 speculation. Then again, funding can get you a more prominent return. For instance, say a financial backer puts down 20% on a house, with a compounding at 4% on the home loan. Subsequent to taking out working costs and extra premiums, the profit amount is down to generally $5,580 each year. Income is lower for the financial backer, yet a 27.9% yearly profit from the $20,000 speculation is a lot higher than the 9.5% brought in by the money purchaser. Number 6. Instructions to get a mortgage for rental property. While an investment property contract is essentially equivalent to a main living place contract, there are a few key contrasts. First of all, there are higher paces of default on investment property credit since borrowers confronting monetary difficulties will generally zero in on an essential home loan first. The additional gamble implies banks regularly charge higher loan costs on investment properties. Then there are the guaranteeing norms, which will generally be more severe for investment properties. As a rule, contract loan specialists center around the borrower's FICO rating, initial installment, and relationship of outstanding debt to take-home pay. Similar elements apply to investment property contracts. However, the borrower will probably be held to more severe FICO rating and DTI limits, and a higher least upfront installment. Furthermore, the money lender might investigate the borrower's business history and pay, and need to consider related knowledge to be a property manager. By and large, this is money lenders' expectations for borrowers to endorse an investment property contract. FICO assessment: a base score of 620 with better rates and terms presented with scores of 740 and higher. Initial installment: it's feasible to put down just 3% on a traditional home loan for the main living place. However, borrowers need to pay private home loan protection, that is PMI, on the off chance that the upfront installment is under 20%. PMI doesn't make a difference to investment property contracts, so borrowers by and large need to put down no less than 15 to 20%. Relationship of outstanding debt to take-home pay, or DTI. DTI addresses the level of borrowers' month-to-month payments that goes toward taking care of obligations. However, restrictions are more adaptable for main living place contracts. Borrowers ought to have a DTI that falls somewhere in the range of 36 to 45% to meet all requirements for an investment property contract. Reserve funds. As well as showing a good relationship of outstanding debt to take-home pay, borrowers ought to likewise have sufficient cash in the bank to cover 3.5 years of home loan installments, including head premium duties and protection. 7. Be careful with high interest rates. The expense of getting cash may be somewhat modest. However, the financing cost on a speculation property is for the most part higher than it is for a conventional home loan. Assuming you truly do choose to back your buy, you want a low home loan installment that will not eat into your month-to-month benefits excessively. 8. Compute your margins. Money Street firms that purchase troubled properties go for the gold 5 to 7% on the grounds that, among different costs, they need to pay staff. People ought to lay out an objective of a 10% return. Gauge support costs at 1% of the property's estimation yearly. Different expenses incorporate mortgage holders' protection, potential property holders' affiliation charges, local charges, month-to-month costs, for example, bother control and finishing, along normal support costs for fixes. 9. Put resources into landlord insurance. Safeguard your new venture. Notwithstanding mortgage holders' protection, investment property proprietors ought to constantly buy landowner protection. This sort of protection for the most part covers property harm, lost rental pay, and responsibility security, on the off chance that an occupant or guest experiences a physical issue because of property upkeep issues. Remember that standard mortgage holders insurance contracts may not cover misfortunes brought about while the house is leased. Contact your protection specialist to ensure you are satisfactorily guaranteed. 10. Figure unexpected costs. It's not simply support and upkeep costs that will eat into your rental payments. There's consistently the potential for a crisis to manifest. Rooftop harm from a typhoon, for example, or burst pipes that obliterate a kitchen floor. Plan to save 20 to 30% of your rental payments for these kinds of expenses so you have an asset to pay for ideal fixes. 11. Keep away from a fixer-upper. It's enticing to search for the house that you can get at a deal and flip into an investment property. In any case, assuming that this is your most memorable property, that is presumably an impractical notion, except if you have a project worker who accomplishes quality work at little to no cost, or you're talented at large-scale home enhancements, you probably would pay a lot to remodel. All things considered, search for a home that is evaluated underneath the market and just needs minor fixes. 12. Work out operating expenses. Working costs on your new property will be somewhere in the range of 35 and 80% of your gross working pay. In the event that you charge $1,500 for lease and your costs come in at $600 a month, you're at 40% for working costs. For a considerably simpler computation, utilize the half rule. Assuming that the lease you charge is $2,000 each month, hope to pay $1,000 in all-out costs. Be practical in your assumptions. Likewise, with any venture, investment property won't create a huge regularly scheduled check immediately, and picking some unacceptable property could be a devastating slip-up. All things considered, investment properties can be a rewarding method for putting resources into land. This is the end of this video. Stay tuned for more. Thanks and goodbye.